Hello, good afternoon, everyone. This is Dave Keller from StockCharts.com here in the global headquarters of StockCharts in Redmond, Washington. Thanks so much for joining us this afternoon for the Final Bar on Wednesday, October 2nd. We were talking yesterday about whether we would get a follow through to the downside. Apparently that has happened. A lot of news flow that's causing stocks to move, but certainly we're feeling the pressure on the downside. So we're going to unpack that, address some questions in the mailbag. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. Thanks so much for joining me today. I've always found, and I will try desperately to not get too excited about stocks going down because I know it's painful if you're on the long side, but I've always joked with my peers as technical analysts in the financial industry. Our phone always rings way more in a bear market than a bull market. So the people have broken that out in a lot of ways. Never confuse brains with the bull market and so forth, right? When everything is going up and to the right, the game feels pretty easy. When things start to correct, when things start to sell off, that's, to be honest, when I think the technical toolkit really shines because it helps you understand potential downside, helps you visualize risk in a meaningful way as opposed to just being worried about what could happen. You have specific guidelines, a toolkit that helps you quantify when you need to take action, when you need to revisit your position. So I kudos to all of you for tuning in to the Final Bar. Hopefully we're able to help you understand how the toolkit can be of help and break down some of the action in stocks today. So this is what the S&P 500 looks like as we head into the close. Just refreshing the chart real quick. We talked yesterday, right? We had traded down. We had this bearish engulfing pattern or a distribution day, an outside day. We talked about why that tends to be more negative than positive because this signifies distribution. This signifies a heaviness as there's distribution during the trading day. And we finished right at this support level, just below 2940, and that lines up very well with the highs from August, also the highs from back at the end of April, beginning of May. So the question was the next day, meaning today, are we going to see some, a little bit of a recovery or do we see some downside follow through? And I think those questions were answered today, right? So a very distributive pattern. We have a gap down and then further downside. This is the S&P cash index. So the spiders will look a little different in terms of the gaps, but overall, directionally, it's pretty meaningful. What's telling to me right now is if, again, depending on how you draw it, we're basically at the 50% retracement of the low from June to the peak that we had in July. And you see that the Fibonacci retracements are actually pretty compelling here in August because we traded basically up and down through those Fibonacci levels, and having an awareness of them was very key. Now we're back into that range, and I think looking at the Fibonacci retracements, where we're at relative to where we've been, but also lining it up to some of the previous highs and lows can be really, really valuable. So if you're not paying attention to that, I certainly would. The other thing to point out when the market sells off like this is just looking at the momentum, right? So this is the RSI indicator. It's a real classic measure of momentum. And if you're not familiar, it very simplistically takes a data series, and it says, what's the average up day versus the average down day? So when the stock or the market trades higher for the day, how much higher does it tend to go on average? And when it goes lower, how much lower? And this is essentially a ratio of the average up move over the average down move over a period of time. So if the RSI is at 50, which is where it had been for a while now, it shows you essentially a lack of momentum, a lack of directional movement. So that essentially tells you an equilibrium between buyers and sellers, sort of in the middle. What's happened now, though, as you can see, we've gone to the lower end and we've gone below 40. And here's where it tends to be pretty interesting. You will find over time that in bull market phases, when the market overall is going higher, the RSI will sort of hover in this range. It won't usually get below 40, and it will get up into the 70, 80 range on a rally. When the market sells off, though, in a bearish phase, you will tend to find it in the lower end. It'll go from 20 on the bottom, and it will never usually get above 60. So what's interesting is as the market returned to previous highs, tested these levels from the end of July, you can see the RSI just got right above 60, and that was it. And if we would continue lower here, that really is showing you that the RSI is in more of a bearish phase than a bullish phase. And again, depending on your time frame, you're trying to win this game in different ways. You're trying to understand market movements in different ways. I tend to try to think 3 to 6, maybe 12 months out down the road and try to understand how the movements now fit into the big picture. And for me, that is one of the key things I'd be looking at, just to see how we move relative to where we've been. This is a quick look at the intraday action in the S&P. We can see the distribution over a 3-day period, the move down out of the open, the consistent sell-off until about 1 p.m., and then a little bit of a recovery, but overall, too little, too late, right? Overall, the pattern has been very distributive, and I think that's the key to it. Looking at the members dashboard here, and if you don't have this set up, like I do, that's fine. You can do your own, but I would definitely encourage you to experiment with some of these different objects you can put on here. You can get a lot of really good information, including a sector summary, which is one of the newer improvements that they made to it. Is really, really good. So here you can actually see very quickly where the sectors are relative to one another. Here's the 11 S&P sectors. So just on today's trading, real estate not up the most, really down the least relative to the rest, but real estate about 72 basis points, utilities about 1.4%. At the bottom, you have energy and financials, consumer staples. So it's really just a dramatic down day from a lot of these sectors. The energy move isn't too much a surprise if you follow the charts. The charts have been what I would call relatively chart challenged for a while. The financial sector, though, is a really interesting one. And if you look at chart of the XLF, this, in my opinion, is one of those charts that helps you understand why the market looks like it does at the big picture level, right? The XLF rallied to new highs, over this period in July. This is after this big head and shoulders or inverted head and shoulders bottom, what some would call a Buddha bottom, but doesn't matter. It's an inverted head and shoulders pattern, a break above the neckline. We're now in more of a constructive phase, but look at what happened soon after we retested those highs in July, right? We start to see more distribution. We see a lower high, and now we have 2 really distributive days. Now, this is coming off of news, TD Ameritrade and going to zero commissions. And obviously that has a lot of ripple effects for money managers, for brokerages and so forth. But, again, forget the news. Remember, the chart is the way I would think about this. Don't let news flow like that cloud your ability to understand the chart from a very simplistic, very clean sense. And it is undeniable that we're seeing distribution on the XLF. So if you are looking at financials, you've been thinking about them, or you have some exposure there, again, I would always start where we're at, what I'd call the final bar, look to the left and see where we're at relative to where we've been. We've now broken below the 50-day moving average. Same thing with the S&P. That's sort of a weaker short-term signal. We're now sort of getting some of these other levels in place. We have the 200-day moving average just around 26.42 or so. And then we also have the lows around 25.75. This is from back in May and then again in August. So, as we sell off here, again, you're always wanting to see where the first time is, where you start to see people nibble a little bit, start to buy. We're entering this, what I would call a demand area, an area where we've bottomed out before. And paying attention on these types of charts, and this will be a theme for the rest of the show here, where we're at relative to where we've been can be a really, really helpful way to pay attention to market movements. That was a quick rundown on the market. I want to transition to the Final Bar Mailbag. As you may or may not know, there are a number of ways you can get questions onto the show, and I'll just outline them very quickly. First, send me an email, thefinalbar@stockcharts.com. That's an easy way to get your questions to me. We review that as a team, and some of the questions that we think would be really helpful to address on the air, we'll do it. You can hit us on Twitter @FinalBarSCTV. And also during the show, we'll have the chat room open. And again, we may not get to your questions during the show, but please put thoughts that you have, even on things that I'm showing. One of the questions I'll review here in a moment came from the chat room yesterday. I wanted to bring it back up. So there are 3 ways you can get a hold of us. I hope you will take advantage of those. And as interactive as we can make the show, I hopefully it'll be of more and more value to you. 3 quick questions to break down from the mailbag over the last 24 hours or so. The first question I had was about annotations on the charts. Someone was asking me about annotating charts, and not necessarily how you do it, but how you save them and where they're able to be saved to. And Chip Anderson, who runs StockCharts, he and I have had a number of heart-to-heart conversations about how to think about annotations and what makes sense and what people would be looking for. So the way you do it, obviously, is you click on the annotations button below the sharp chart. You click on the tool that you want to use. So I'll just do a quick trend line. You click once, and you drag it to put the line on here. Now, what you then need to do, you're sort of in a working, you're in an active workbook here. You click the X, hit the save, and it's going to ask you where you would want to save it. You can save it, put it on one of your chart lists. You can, name the title, whatever you want. I usually put like the ticker and the date or something like that. And that's the way you do it. The question in particular was, does it save trend lines by ticker or is it by chart? And the way that StockCharts is designed, it's all built around the chart list system. And if you're not familiar with that, two things I would suggest you do. Number one, go to your member dashboard, click on chart lists, and it might be blank or you might have some ones in there to start. You can go through there. The way you learn how to use these is go watch Greg Schnell's videos on YouTube on the StockCharts channel. He runs The Canadian Technician. He's been a guest on a number of shows. He is a genius. He knows this space better than anyone I've worked with before. If you watch his videos, he gets around these like a champion. So it's basically saves each of those charts. You save them as a group, as a list of charts by chart list, and that's the way you can save annotations. What's helpful about that? So I have a list that I refer to all the time, which is my, where is it? It's my watch list for the mindful investor. And basically, here, let me get up here. You basically can save a list of charts, and then all your annotations, all your thoughts are all saved on there, all your trend lines, for example, and you can always refer back to them and make sure you have a good sense of where things are relative to your notes. So thanks for that question on annotations. That's the first one. The second one was when we were talking about the S&P 500 yesterday. Someone said, what about the big double top here? And I don't know if I mentioned that. I don't think I did. So what do you make of that, right? So my comment back to that is patterns, right? When we talk about double top patterns, head and shoulders patterns, triangle patterns, coils, all these different sort of visual patterns, they are purely visual tools, right? So identifying something as a double top is something you do visually. And what I mean by that is you and I might look at the same chart and have a different opinion as to whether something is a double top or a lower high or a breakout or whatever, depending on just how it looks relative to other things. So my number one question to you is it's a little bit subjective. So in my opinion, I'm not seeing necessarily the S&P as a double top. I'm seeing it more as a lower high. And when I zoom out a little bit, I just see that lower high, and I also see the lower highs in things like the NASDAQ composite, the NYSE composite, the Dow. You can see how a lot of these have a lower high. So in my mind, the S&P chart looks very similar to those. Now others, and maybe for example, the XLF, the financial sector might be a good example of where that maybe looks a little different, looks more like a double top. And again, these look so similar, so don't hate me if you disagree. But in my mind, something like that where you've hit a consistent resistance level seems kind of consistent to me. So the short answer is you certainly could see it that way. I think in both of our opinions, the analysis is similar. This is a market or this is a chart that has failed near or at a previous level of significance, and that's really the main takeaway to pay attention to. And as always, anytime you see something like a double top pattern, it's all about what we do relative to the interim low, right? So where are we at relative to that low between those two peaks? And if and when the S&P, the XLF, and other markets start to break down below those swing lows, mostly from August, I think that's where things will start to feel climactically worse than they may have before. So that's what I've been looking for there. Thanks for the question on the double top in the S&P. The third question I want to address with you was yesterday when we were talking about the dollar, I showed a chart of the UUP, and someone asked, why the heck, and I'm summarizing, why the heck are you using the UUP? Because the dollar index is so much of a more pure read on the dollar. And my short answer is, you're right. And the long answer is as follows, right? So here on one of my lists here, we're looking at the US dollar index on the left, the UUP, which is a dollar ETF on the right here, and I'm identifying with the mouse. So the US dollar index, we only have end of day data at this point, and we're, as I mentioned to the person that wrote to me, I emailed you back and said we're looking at some data alternatives, seeing if there's a better real-time alternative we can sort of capture. But for now, it's really captured end of day and lets us capture the long-term trend. So that really is the long-term trend in the dollar, heavily weighted toward the euro, of course. The UUP has some different weightings, so it might be weighted differently versus other currency pairs. You can just see directionally, the UUP looks a lot more bullish consistently, just in a consistent uptrend, versus the US dollar index, which is a little more volatile, a little more sideways. So when I was talking about the UUP chart, the dollar probably looks a lot more attractive when you look at that chart. And a lot of that might be a little bit artificial because it's based on, again, some other weightings. The challenge with the dollar, there's actually a lot of different ways to think of it. You could look at the regular dollar, which a lot of times just looks like the inverse of the chart of the euro because it's so heavily weighted to that. A lot of people look at a trade weighted dollar, some other weightings just to try and get the euro to be less of a huge weighting on it. I tend to look at the UUP because in short-term timeframes, if you're looking at a couple days, the movements are identical, the directional movements are the same, so it kind of gives you the same thing. But if you are looking at a longer-term trend, you're absolutely right, and thanks again for the question. The US dollar index, dollar USD, is certainly a better read on the long-term trend in the US dollar. So those are a couple questions. Again, please keep in mind, email us, thefinalbar@stockcharts.com, also on Twitter and in the chat room on the show. Happy to address your questions in future shows. We're going to take a quick commercial break, and then I'm going to come back, share an interview I had with Ralph Acampora recently. I think you're really going to enjoy. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller, Chief Market Strategist at StockCharts here in Redmond, Washington. Thanks again for joining us today. Really have enjoyed these first couple days of the Final Bar. I hope this is the beginning of a great journey together of understanding visualizations. I had a chance to sit down with Ralph Acampora, who is a mentor of mine and a mentor for so many on Wall Street. Ralph, we've always joked, has educated Wall Street on technical analysis, and that is not an overstatement. He really has. He taught a course at the New York Institute of Finance for decades. I'm talking decades, his career over 50 years. I had a chance to talk with Ralph a number of weeks ago, just talking about his process, picking apart his devotion to education, how he thinks of things, and specifically recommendations for people just getting started with charts and technical analysis. I want to share with you a little bit of that conversation. We'll come back and sort of wrap up some of my main takeaways. So here's a conversation I had recently with legendary, the Godfather of Technical Analysis, Ralph Acampora. Can you just talk about, like, when I would ask you about your routine, how would you describe your market analysis routine at this point, and how has that evolved over time? So if you're going to get started on looking at where things are, how do you kind of go about that? What's your routine look like?
Well, I get up in the morning, of course, I'm listening to all the talking heads on television, just kind of get a flavor of, what they're saying and what they're thinking, kind of like a pulse beat of sentiment, if you will. And I have a spreadsheet. I'm an old timer now, okay? I have a spreadsheet that's hooked up to my Reuters system. And what I do for all the S&P stocks, S&P 500 stocks, I do it for all the ETFs. I love ETFs because it's, you got 10 of them and you got all the sectors and everything, and a couple of them you get all the European markets and everything. With a handful of ETFs, you can literally follow the world, literally.
Yeah.
And what I do is I input onto my spreadsheet all the support, minor, major resistance, and trends for every one of them. Plus, I have the system. Of course, it's calculating the moving averages and RSI, whether it's overbought or oversold. And I sit there and just wait for the flashing signs. Red is obviously breaking support levels or breaking trends, and green is obviously breaking out resistance, moving up or hitting my targets. And I can literally say this, David: nothing moves in the world without me seeing it. That's what I do, and it's probably the most basic and the simplest way of looking at things. I literally look, whether it would be candlestick charts or regular bar charts, and I draw my trend lines. I mean, I'm a big trend follower. I mean, they all say trend's your friend and all. It really is. And I like the RSI and I like MACDs. I like them on a weekly and monthly basis. Daily, I get too much noise. I'm basically, in all my careers and all the big firms that I worked for in Wall Street over the years, I was always asked to write a market letter that looked out into the future. Mm-hmm. In other words, at Christmas time, all my clients had my 20-page report under their Christmas tree. They could read it and see what Ralph's long-term opinion is for the new year, for the coming year. And I get upset when people say to me that technical analysis is for traders only. That's nonsense. You can use technical analysis for long-term opinions. And then my weekly letters would be updating that opinion. I'd say we're on course or have to make a little adjustment. And so that's what I do.
That's great to hear, especially with your use of the spreadsheet that you described, because I have a lot of people that I talk to that either, do things very manually, like they have a very traditional process, mm-hmm. or they're doing mm-hmm. something very systematically, very quantitatively, and kind of going all into some sort of model. And you're kind of in the middle, which is it's a subjective approach, but you're leveraging some computing power to, to surface some of the things that you should pay attention to, which is really, really cool. I like
absolutely.
that.
Yeah. Thank you.
You mentioned a little earlier in the beginning of your process, first thing you do is flick on the TV, listen to the talking heads, see what people are saying, just to sort of get a read on, the overall sentiment, what's happening. Now, you've been involved in media for a number of years. How have you seen the treatment in media of technical analysis or market analysis? How has that changed over time? And what do you think now in terms of social media and all the newer ways? I know you're active on Twitter and other places. How do you think that's sort of evolved the world as well?
That is an absolutely wonderful question. And I say that sincerely. I turn on the TV and I listen to all these talking heads. Now they're talking about Fibonacci numbers. They're talking about moving averages. And I'm happy to hear that, but I'm scared to death because the viewing audience that has no idea what they're talking about. Because that's where the education comes in. That's where we have to educate people. Got to get that CMT designation because that's the one that'll force you to read all the right books. And so we've come a long, long way. Trust me. And 52 years ago, when Johnny and I were walking around, we were angry because the fundamental analysts wouldn't even talk to us. And now they're starting to, you can hear mumbling coming back, and that's kind of interesting. But it's, as I said, it's the lack of the education that really, that's where we have to do. So that's where the CMT organization is really at its best to bring the subject to people. That's what I hear. Yeah.
I think one of the most dangerous things is people that think they've learned everything there is to learn. Because I think you've pointed out that I think one of my favorite things about this industry and about this discipline is that there's always something additional to learn. The market's always evolving, right?
That's what's so wonderful about the whole business. Every day is different.
That was such a fun opportunity to sit down with Ralph and chat about a number of things. That was just a little 5-minute snippet of a much larger conversation, but I thought it was appropriate to share with you. A couple themes that I thought were really, really great from my conversation. Number one, Ralph has been so devoted for much of his career to educating and still is very passionate about that. Which was really cool to hear. We talked a lot about his routine, just his process, and it was a good reminder that, no matter where you're at in your journey, if you're just getting started or if you're pretty seasoned of an analyst, it always is meaningful to have a good process. And then, there's always something new to learn. That's what attracted me to the industry and so many of us as well. So that was a really cool conversation with Ralph. We'll look to do more of those sorts of discussions with people and share them with you as much as we can. We're going to rotate now and talk about shifting stocks. So one of the things we love to come back to is just focusing on individual names, groups, themes that are moving. To do that, we're going to use the StockCharts member dashboard. So if you go to your dashboard page, if you don't have some of these things on here, to be honest, if you click on the little gear button, make sure you select additional data panels and you can add some of the features that I'm showing on mine. Yours is going to look a little bit different. That's okay. But this is the way I'm looking at it. I always look at the scooter rankings, look at the top 10 stocks just to remember what's really getting it done in the U.S. equity space, large cap space. And then stocks with the biggest up moves and the biggest down moves today. And if you look at those lists pretty consistently, you'll have a pretty good sense of what's moving and what's rotating, where the opportunities are. I think it's worth looking at, first off, if you can see as I hover over some of these names, a lot of these names that have been some of the best stocks, obviously still selling off today along with everything else. So if you look at the final bar there, that last candle, you can see how a lot of these names that have been consistent winners are all kind of coming back a little bit. It's worth noting, though, where that's not the case. And again, I would always encourage you on a big down day, focus on some of the things that aren't even showing that. Focus on something like home builders. So we saw Lennar Homes, saw a couple other home builders on there as well. This is a stock that's up big on a down day in the market. These are stocks that have something going on with them, that there's something behind the scenes, and yet I don't have to know what it is. I just know from the chart. The charts will tell me how I should probably feel about the stock. So there are a number of places that are still fine, and what you will find from this page is, regardless of the big picture market movements, there are always stocks on each of these lists. There are always stocks moving up and moving down and rotating. So what was actually rotating higher today on a down day? Besides some of the home builders, Johnson & Johnson was actually one of the larger cap names that rallied pretty big. Now, this is a little bit deceptive. I wouldn't call this the most positive bar in the history of bar charts because we opened up, we traded much higher, got above the 200-day moving average, but closed below. So a lot of times when you think about a long-term average, you always look for follow-through. You look for some sort of confirmation. I would not say we've had that yet from Johnson & Johnson. This is obviously a big pharma name, a big weight in the healthcare sector. And the fact that it's not quite gotten through there, not had the upside confirmation, I think is pretty compelling, something to pay attention to. We've talked about gold stocks before, and we had Jesse Felder on Monday of this week talking about an outlook for gold, really a long-term outlook for gold. It was interesting that Newmont Mining was one of the top up movers. And again, the fact that this chart is one of the best movers today tells you how bad the average stock actually has done in the last 24 hours. A little rough session for sure. And again, on a lot of the gold stocks and on Newmont Mining in particular, you've got a clear support level around 37.50. You definitely would want to see that hold to feel better about the long-term prospects here. A break below there, a break below support could certainly indicate some further potential downside. Going down the list, waste management is actually a really interesting one because this is a chart that had been in such a good relative shape. You can see how this has been a consistent positive performer, all rotating lower to the downside. So not the most encouraging thing. We'll have to see if there's follow through. Just one quick on the downside. Airlines down big today. Trade news that's impacting a lot of the charts. UAL is probably one of the worst ones, jumping down $4 to a low around 82 today. Recovering a little bit, just almost to 84, but support levels with all those airlines. Again, start with the current chart, look to the left, and we'll have a good sense of what to pay attention to. So that's a quick run through some of the stocks shifting around today. We're going to go to the 3 and 3. And as we've talked about, the 3 and 3 is something we will do on every show, time permitting, and I'm doing my best to keep to the schedule. But with 3 minutes or less, we will go through 3 key charts that you should pay attention to. So if you tune in to nothing until 4:26 p.m. Eastern, I hope you will watch these 3 minutes and make note of these charts because these are ones I think are most impactful. The XLF is the first one. We talked about that earlier. This was the mystery chart yesterday. If you didn't tune in, this is a mystery. Mystery chart is a routine segment that we do. What's interesting about the financial stocks with a lot of the banks, the brokers, obviously a lot of downside based on the news with zero commissions, and that's certainly gonna likely proliferate. But you can see 2 strong down days. And again, this is an area where I certainly would be looking to the left and identifying if we're able to find support. And a lot of those stocks like JP Morgan, Goldman Sachs, were setting up for these beautiful breakouts. And I think that might be under question now. I think you have to sort of watch those for some key signals. The second one, we're going to finish with 2 stocks. This is a chart of Apple. And remember with Apple, it's always interesting to look at Microsoft, Apple, some of the largest names. And again, this isn't the market. There are plenty of stocks going up and down, but the biggest names have the biggest weight in the indexes and have the biggest opportunity to change the movements in the overall S&P. The Apple has sold off a little bit today, as with everything else, but look at how much better it looks than some of the other charts, right? A lot of charts are breaking down, testing support. If you didn't know that the charts were getting negative, the long-term trend actually looks pretty healthy, even though it's down almost 2.5% today. So a big move. These numbers are a little deceiving, but overall, it's still a strong performer. And again, as long as a stock like that is holding up, there's still upside to be had in places like technology for sure. The final chart of the 3 and 3 is the S&P breadth by cap tiers. And I want to say we've used this before. I've certainly showed it on the air before, but I wanted to talk through it really quickly. This is the S&P 500 closing on the top, just the daily close. And then we have the breadth on the S&P, on the broad New York Stock Exchange, on the mid-cap index, on the small cap index. I have very simply color-coded these green or red based on where they're at relative to the highs from earlier in the year. And you can see that the small cap breadth is the first one to break down through that support level that I identified. So that is the first one to go red. I think if you continue to see this rollover in the advanced decline lines, this is why people were so positive, so encouraged at the beginning of September. All of those patterns are starting to roll over a little bit, right? So if you don't have this chart, if you want to figure out how to get it, I have a chart list called the Mindful Investor Chart List. If you don't have access to it, just shoot me an email, thefinalbar@stockcharts.com, and I'll send you the link. Just bookmark it on your browser, and you can always refer back to it. You get a sense of where things were at. Ladies and gentlemen, that was the Final Bar for today on Wednesday, October 2nd. Thanks so much, as always, for joining me. As we go on, we're going to continue to have a number of great guests. We have a couple lined up for tomorrow and into next week. Thanks so much for joining us. Thanks for using StockCharts.com for the Final Bar. This is Dave Keller signing out.
Bye.